morning. My name is Susanne Mariga, and I'm the managing member of Mariga CPA, and we are a certified public accounting firm that specializes in outsourced accounting, tax, as well as profit-first coaching, and we specialize in the healthcare staffing industry. And today, as part of our series of the biggest mistakes that occurs in healthcare staffing, we're going to talk about, in my opinion, one of the the number one biggest mistakes that happens in healthcare staffing, and that's the belief that we can trade margins for volume. And personally, I remember when I first started my own business, I would go to these networking events and I was just so excited to be able to be in the room with these really large companies that when they asked me to discount my prices, I didn't think twice about it. And it's a mistake that happens a lot in new businesses and businesses in general. We're just so excited to land that big contract that we think, okay, if we discount our price, we'll make it up in value. But what happens is we realize when we're in it is that it's very hard to make up in terms of value, because when we cut our margins, we cut our profitability. And when we cut our profitability, we can no longer scale. And by scale, that means that we can no longer be able to invest in our business to be able to recruit the talent that we need internally to service these clients as we grow, because our profit margins are so small. For a moment, let's take a look at the example. So friends, I want to share a spreadsheet, and the spreadsheet data is coming from a study that was conducted in 2017 by the American Staffing Association, and the study was called Understanding Staffing Profits. So one of the things I want to keep in mind, though, is you being in the healthcare staffing industry, this is a very simplified version. So there's going to be some other things that you're going to want to consider as part of your business. For example, if you have travel nurses, you're going to have per diem rate, you're going to have credentialing costs, you're going to have potentially higher insurance. And so you're going to want to make sure your markup adequately reflects those additional costs that you are incurring. But this is a study that was conducted on the spectrum of the entire staffing industry as a whole. And what they're seeing is that the average hourly rate per worker is $17 an hour. So that means there are some higher ones, there are some lower ones, but on average, $17 an hour is what they're seeing. There's a 55% markup on average. And so what that means is that $17 an hour is producing a billable rate of $26.35. Now, out of this billable rate of $26.35, $17 is going towards the direct labor as the wage for the employee. $1.30 is going towards the FICA, which is 7.65% of the hourly wage. FUTA is taking about 6% of the hourly wage, and then you've got SUTA, which is going to be about 4% on average. And you've got workers' comp, which is they're seeing is about 1.29% of the average billable rate. So what they're seeing is direct labor is costing about $20.34. And what that means is that from a margin standpoint, the gross margin is $6.01. So that means out of the direct bill rate less the direct labor rate, it's about $6.01 left over per hour. However, there's a cost to recruit. You have to have recruiters on site. You have to run Indeed ads. You may have to have an office space where people can come in and test. So we're seeing about $5 go towards general administrative costs, or 18.7% of the total bill rate. And after that is paid, that means you only have $1.08 per hour, or 4% of the bill rate left as profit. And so what we're seeing is that the staffing industry is really a volume-based business from the get-go. So let's look at a real life example where what happens when we choose to discount our rates. So here at our national average of 55%, in this case, we're going to have about $1 million in billable payroll. And at $1 million payroll, you're going to have a $1,550,000 revenue. You're going to pay your payroll taxes. So $76,500 is going to go to FICA, $60,000 is going to go to FUTA, $40,000 is going to go to SUTA. So about $176,500 is going to go to payroll taxes. And then $20,000 is going to go to workers' comp. And so that means your direct labor cost is going to be $1,196,500. And that's going to produce for you a gross margin of about $353,500. Gross margin, again, is revenue less the direct labor costs. Now, based upon the American Association staffing study, about 18.71% is going to go to general administrative. So cost to recruit, cost to have office space, cost to place ads. It's going to be about $290,000 in this example. And that's going to produce for you profit of $63,500, or 4% of the bill rate. Now, let's say I go to a networking meeting and I am feeling a little generous and I really want to get this business. So I'm going to discount my business by my markup by about 5%. Let's see what happens. So my payroll is going to stay the same. My workers are only going to work for so little. And if I'm not making average payroll, they're going to go to another staffing service where they're going to make more. My FICA is going to stay the same. My SUTA is going to stay the same. My workers' comp is going to stay the same. Really, my direct cost for labor is going to stay the same. So if it was $1,196,500 billing at the national average, it's going to be $1,196,500 billing at my discounted rate. But what's going to happen is my margins are going to be less because my revenue is less. And my margins are going to be less by about $50,000 in this example. And my general administrative expenses are going to stay the same because just because I discount your prices, I take pride in my work. I'm still going to give you the same quality service that I would have provided you had I'm not discounting your rate. And so what happens is I've lost profitability by $50,000. Under national rate, using 55% markup, I could have had $63,500, but because I discounted your rate by 5%, I'm only making $13,500. So I am losing $50,000 in net profit because I chose to give you a 5% discount. Not very smart business, right? So let's say my client says, okay, Susanne, because you've been so good to me, I'm going to make this up to you in value. Let's see what happens. Let's see how much volume do I need to make up to equalize this discount rate. So on my national average, we said my profitability was $63,500, and I want to make that under my discounted rate. So what happens though is I have to now, instead of paying or charging $1,550,000, I have to now bill for $7,376,676.47. And my payroll cost has gone up too now because now I have to place more workers from a value standpoint. Instead of having $1 million in payroll, I now got $4.7 million in payroll. Plus my taxes have gone up. I've got more FICA, more FUTA, more SUTA, more workers' comp. My workers' comp even jumped by $72,000, almost $73,000. And so my direct labor cost has really changed from $1,196,500 to $5,586,132.35, almost a $4.4 million increase in direct labor. Now, it looks like I've got higher gross margin, but guess what? It costs me now more to place this $4.7 million in payroll and recruit for them because I have to have more structure. I have to have a better office space where they can come in and test. I have to have more recruiters on board. It costs me a whole lot more to earn the same profit that I could have earned had I just charged a national billing rate. So what does this mean in hours? Well, under national billing rate to earn that $63,500, I only had to charge $58,824 billable hours. But now because I discounted it by 5%, I now have to charge in $274,654 in billable hours. So that's a $215,830 billable hour difference. And in full-time equivalent, it's about 103 extra employees I had to hire in order to make up that difference because of the volume. And so what you're seeing is I have to work a whole lot harder to generate the same profit just because I decided to discount the price. And so friends, what I'm saying is that trading margins for volume just does not work. And this is why. I had a professor once tell me that to compete upon prices and to compete with just matching prices and meeting competitors' prices, nothing more than a race towards the bottom. Anyone is going to be able to meet your price. Anyone's going to be able to undercut you. But no one is going to be able to bring to the table what you bring to when you work on differentiating yourself from your competitors. And what that means is that when you trade margin for volume, it doesn't work. And so you have to find something to really make yourself stand out in your market, whether that be being the one that's known for delivering fast services, meaning that if an order comes in, you're quickly able to fill it, that you've already got a pipeline that's full of great talent And when someone calls within 24 hours, you can fill that talent with no problem at all. And maybe that you listen to what your clients want. Are they telling you that, this is our culture, we need someone that can thrive in an environment that is under pressure, that has high demands, and you're known for being able to listen to what they need and be able to meet that demand. It could mean that you're serving in a underserved market right now, that you are looking at your market and going, where's an area that I can add value that isn't already being served? Is there something that I can do to better service that market? And again, what you're doing is differentiating yourself. You're making yourself stand out above the rest. And that, that trade-off between price and margin is appealing for the client versus picking somebody else. So again, you cannot compete and trade margins for value, but what you can do is differentiate yourself. Know what your customer wants. Make yourself different. Be a better deliver quality. Be a more creative provider of solutions. Provide training to your client. Provide better trained workers to your clients. But whatever you do, please, friends, do not trade margins for value. Until next time, I look forward to talking again. Goodbye.